Welcome, everyone, to the Information's TITV. My name is Stephanie Palazzolo, and it's Tuesday, August 4th. First up, we'll discuss the big news of the morning, the acquisition of once high-flying productivity startup Airtable for a fraction of its last valuation. Then the Information published a great analysis this morning ahead of SpaceX earnings, making an argument in favor of a merger with Elon Musk's other company, Tesla. Our financial analysis columnist crunched the numbers, and she'll walk us through her story. We'll then discuss how Coinbase and other tech firms are building their own AI coding agents as an alternative to pricier options from giants like Anthropic and OpenAI. And we'll wrap the show with a discussion with the CEO of AI interpretability startup Goodfire about their new product launch. I'm really looking forward to all these discussions. Italian conglomerate Bending Spoons has agreed to acquire productivity startup Airtable for around $1.3 billion. That's a steep drop from its $11 billion valuation it had just 5 years ago, as enterprise software companies face mounting pressure to prove their value in the AI era. Here to comment is Aaref Hilaly, partner at Bain Capital Ventures, and Chase Packard, founding partner at Marathon Management Partners. Welcome, Aaref and Chase. Great to have you both on the show.
Thank you. It's great to be here.
Thanks for having us.
So, our 5 years ago, Airtable was one of the hottest software startups out there. Today, it's getting bought for a fraction of its last price. What happened, and what do you make of the acquisition?
Well, I think that there are a lot of companies that are worth 10% of their 2021 valuations. And so Airtable is not uncommon. And what happened is AI and, the SaaS apocalypse, if you like, that legacy SaaS companies are just worth much less in a world where they're likely over time going to be displaced by new AI native solutions.
I think the phrase "what happened is AI" can apply to a lot of things
It's true.
that have occurred in the last 5 years. Chase, do you think people are misunderstanding anything about the deal?
Yeah, one thing I haven't heard people talk about much is the week before the deal, Airtable split it into the core business and then their new AI business called HyperAgent. It's unclear what exactly Vending Spoons required, if it's the entire company or just the core business. But if it's splitting off the core business and the AI business, changes the deal completely. It's cleaning house and adjusting to the new reality of an AI first world.
So this seems like new information. As you mentioned, it sounds like they split off between HyperAgent and the core business. Do you know anything about what this means for investors? Are they going to get equity in the spun off entity, HyperAgent?
It's unclear right now from what I've seen. They have equity in both. The split happened before the merger was announced, so I wouldn't be surprised if we see an announcement in the coming weeks of the core Airtable team focusing on the HyperAgent project versus Airtable within that instance.
hmm And your read on this is HyperAgent is the kind of maybe AI native or AI first product, and it's
Correct.
it's a
Yeah.
bet on that.
Correct. Yeah. How he announced it, I believe about 4 months ago, and it's where a lot of the engineering team's been focused recently, and I believe what he views as the future of the product.
I think it's worth breaking down this deal from the perspective of the different stakeholders, Stephanie, because I think this will be a common phenomena for SaaS companies as things go forward. So if we look separately at Bending Spoon, let's first look for Bending Spoons. Bending Spoons got a great deal. It's 1.285 billion net of cash for a company with 500,000 customers and 80% of the Fortune 500 using their product, 480 million in ARR, growing 20%. So that's a 4.7 revenue multiple or 2.7 equity net of cash. I think they objectively got a great deal. For investors and for the founders, well, the founders probably took liquidity along the way and will still get, a chunk of the proceeds, and the investors get their money back and get to move on. So I think they're fine. That this is all kind of like part of the thing of starting a company and investing in startups. I think that the people you have to feel for are the employees. Some of them will feel really hard done by, and it'll be jarring and a shock to them because in the secondary market, Airtable was trading at 4 billion pretty recently. And they will be, I think, today very worried about will they get anything for their shares. I I think it's hard to tell off the bat, but it looks like if you do the math, there should be about 850 million left over for common shareholders on this deal. The founders probably own about 20% of the company, so they'll take that. The ESOP, if it has 15%, that would mean 127 million spread across 900 people. So common shareholders should get something from this, just nowhere near what they were hoping for.
Mm. It does sound like maybe employees were left kind of holding the short end of the stick. I mean, obviously hindsight is 2020, but Arif, I'm curious, looking back, do you think there's anything that they should have done differently or a pivot that should have happened, or is it just kind of out of their control and they were betting on no code and now AI has kind of just totally subsumed that?
I think it's really hard to second guess management teams when they're
Mhm.
dealing with so many different things at the same time. Of course, if you go back in time, I'm sure the Airtable team would do things differently over the last 5 years. They might have leaned into AI more heavily, but it's easy to armchair quarterback that when they're the ones building a company. And let's not forget, built a really successful product here that has thousands and thousands of customers and millions of happy users. And I think they all have a lot to be proud of.
Mhm. Again, yeah, I think it's tough to, look back now with all the information that we do have, and in that moment, I think it's super hard to know what to do next. I mean, taking a step back, I think it's interesting to think about what this is gonna mean for the kind of broader class of older enterprise software companies. I mean, Chase, do you think this is an isolated case? Are we gonna see more of these types of deals? And if so, what types of enterprise software companies do you think are on the table here for this to happen to as well?
Yeah, I think Airtable isn't the exception; it's the opening act. And there's two kinds of at risk pricing that was wrong that gets bought, and built wrong that gets deleted. I think this bucket one, they raised ahead of their skis in 2021. They get consolidated by PE strategics, operators like Bending Spoons. Thoma Bravo did over 42 billion of transaction volume in 2025. This is where Airtable lives. They find homes. The fight is over, and that's where the only debate after that is where the preference stack is. I think bucket two is the companies that are built wrong. These have AI risks. These are where the product itself is commoditized by AI. The February 2026 SaaS apocalypse wiped out almost 300 billion of market cap in a week because AI worked. Customers are cutting seats as AI does more and agents take more of this work.
Mhm,
Yeah, I agree. I mean, I feel there are two strategies for a startup a software company, I'll say. One is what venture capital set up for. You're going to grow 100, you're going to have triple digit ARR growing in triple digits. You're going to be part of the zeitgeist. You're going to take over the world. And then the alternative strategy is kind of far from that. It is we're going to embrace 20% growth. We're not going to try and take over the world. We're going to cut costs. We're going to stop speculative R&D and make incremental improvements. And most importantly, we're going to raise price and monetize our existing base. Sort of the IBM mainframe strategy. And that anyone stuck between those two, I think, has a hard time. And so Airtable is moving from strategy one to strategy two with this acquisition.
mhm. Do you have a opinion on which strategy is better, or does it just kind of depend on the specific
Well, I
firm?
mean, you don't get to pick. If you can do the take
Mhm.
over the world strategy and grow at
That's true.
100%, then who would not do that? Of course, everyone would love that. But if you can't do that, if that is not possible, then you have to look again at plan B.
Mhm. I mean, I think a question for both of you, I think there definitely are, parallels here to a question that I think many investors are facing now, looking at their own, portfolio companies where we as much as AI maybe ate up SaaS, or this is like a narrative that's going around, I think people are worried now that the AI labs might eat up AI applications, or at least take a big chunk out of their, kind of pie. How does this kind of influence how you're thinking about the AI apps that you've invested in, and maybe the threat from model developers who are also building competing apps? Maybe R, if we can start with you.
Yeah, sure. I mean, I work with a number of these companies like Cognition, Decagon, and Simile. And what I see is there is no one model that will take over them all. And most of our companies are not just using foundation model products from the labs. They're also using open weight models, and they're finding them really effective at a bunch of things. And so, I think the chances that the labs take over the application layer completely is zero, and that the application companies can deliver a ton of value by selecting the right model for the right job and by helping with the human diffusion problem of actually getting people comfortable with AI and using AI, which itself is a big challenge.
Mhm.
Yeah, I agree. The foundational models are under the most pressure they've been in quite some time, which is great to see. Open source is getting more and more popular. I think the safest at the application layer is always going to be things with data moats, regulatory moats, within a specific vertical where there's sensitivities around end users or customer data or things like that. Those are always going to have moats, whether it's on the foundational model side or on the vertical app side.
Mhm. Well, we'll have to have both of you back on for the next, big enterprise software deal, which I'm sure will happen very soon. Again, thank you both for coming on. And that's Aaref Hilaly, partner at Bain Capital Ventures, and Chase Packard, founding partner at Marathon Management Partners.
Thank you for having us, Stephanie.
Thank you for having us.
SpaceX is reporting its first ever quarterly results today. Ahead of that report, the information published a story analyzing a SpaceX-Tesla merger and how it could benefit shareholders. Our financial analysis columnist, Anita Ramaswamy, joins me now with her verdict. Welcome, Anita.
Hi, Steph. Happy to be here.
So, a SpaceX-Tesla merger, yay or nay for shareholders of both companies?
So it sounds on the surface like it might not be the greatest idea considering some of Elon Musk's track record and past deals. But what I ultimately concluded after talking to investors and really analyzing the financials of both companies is that it's a yes.
That's awesome. So let's get into your reasoning a little bit here. One of the reasons you talk about is eliminating conflicts of interest between Elon Musk's companies. As we all know, he runs SpaceX, he runs Tesla, he ran XAI, which is now part of SpaceX. Is this just kind of the next natural step for him?
In some ways, yes, it is, Steph. So the thing is that a lot of Elon Musk shareholders who I talked to, who are shareholders in either Tesla or SpaceX or both, they're really believers in Elon Musk's long-term vision. And, they're taking a lot of these sort of frontier edge bets where they might believe in Optimus and humanoid robotics, or they might believe in, the future of rocketry, or they might believe in, his ability to turn XAI/SpaceX into a long-term AI business, whether that's through renting out compute or whether that is through, building their own AI models. And all of these possibilities have not materialized and probably will take several years to actually get there. But in the meantime, a lot of the investors who I spoke to were saying that, look, if I'm an investor in Tesla, I want Elon Musk's incentives to be aligned to create value for me. And so if he's spending all his time on SpaceX, then I'm not necessarily going to capture the value of Musk running those combined companies. And I do want to draw a historical parallel because I think the deal that a lot of people were talking to me about was the deal for the acquisition of Solar City that Tesla did back in the 2010s. That was a very different transaction where it was perceived as Elon Musk sort of rescuing this company that was run by his cousins, solar business, and folding that into Tesla. And the point that I wanted to make with this column is that this time around is actually different. It's not a bailout of a failing company. It is combining these two businesses that are making some really risky bets that may or may not play out, but ultimately, if you're a believer in the long-term vision of Elon Musk, you're going to want to see him sort of align and consolidate his business interests, eliminate any potential conflicts of interest, and focus on running the combined company.
And I think something that you also mentioned too in your column is this idea that these two companies are already sharing resources, it sounds like. And so combining would just make it easier to do so. Talk a bit about that.
Yeah, so they are sharing resources in a lot of ways. I mean, one example is that Elon Musk he tends to move executives and employees around between his various companies pretty freely. And, if you think about the actual products and how they're being operationalized, right now, Grok models, through XAI are being used in Tesla cars to help guide some of the self-driving capabilities and technologies. And so right now, if, let's say Tesla is actually buying its compute from XAI, they're doing so probably at retail prices. And, if these companies were actually to consolidate, they can find some cost savings through that. Like maybe they don't have to pay full price for compute. Maybe their incentives are more aligned. Maybe they can find some ways to save on infrastructure and the broader AI build out. A lot of these synergies are not the most distinct. Like right now, it's investors sort of saying, oh, he could do this or he could do that. And ultimately, we will have to see what Elon Musk himself decides to pitch if he decides to go forward with this deal.
And, you talk a bit about the math of this potential deal as well. Um, I think an interesting point here is that the recent performance of SpaceX's stock, while maybe not something that makes SpaceX investors super happy, it could actually make this sort of combination easier. What did you kind of find there with that math?
So, SpaceX went public pretty recently, and when it went public, it was valued a lot more highly than it is today. It reached a high share price of $211 per share. And so that was like a $2.8 trillion equity valuation for the market cap. And now the market cap of SpaceX is closer to 1.5 trillion. So when you look and compare SpaceX and Tesla as two standalone companies, they are actually now trading at a forward price to earnings ratio that is very similar. And I think that makes a deal look a lot more palatable to shareholders. And, as a SpaceX investor, maybe you were happy, yes, of course, that your stock was worth 211 per share. At the same time, that valuation was just not rooted in reality fundamentally. And so I think this is the market correction makes sense that the SpaceX valuation of the stock has come down. And even though it might make it a little bit harder, at first glance, you might think, okay, it's going to make it harder because SpaceX doesn't have as much stock that they can, or their stock isn't worth as much to be able to do the acquisition. I think that it's healthy that the valuation has come down to a level where it is realistic. And these two companies trading at a similar valuation makes it an easier sell to see how they can benefit one another. So it's not just a deal that's lopsided, like, oh, SpaceX is bailing out Tesla or Tesla's bailing out SpaceX. It's like, no, they actually trade at really similar levels. And so combining the two makes a lot more sense.
Mhm. And obviously today is their first earnings, very exciting. I think a lot of people are looking forward to it. What are the kind of big questions that you're looking to perhaps get answered today that might make this question of a merger clearer?
Well, this whole idea of a merger really came up in the Tesla earnings call. I mean, it had come up many times before, and people had speculated, okay, maybe this is Elon Musk's grand plan and this is what he wants to do. During the Tesla earnings call a couple weeks ago, he sort of coyly answered that he was not going to answer questions about the deal. And he said if any such thing happened, it would have to go through an appropriate process. So I highly suspect that he's going to get some questions from analysts on the call today about whether or not he would proceed with such a thing. And it's going to be interesting to see how he chooses to respond. He will probably officially decline to comment, but with Elon, we always tend to get some signal and some, sort of other body language or indicators of what his next move is. And I think this is just something that investors are seeing as very, very much on the table.
Mhm. So keep a lookout for maybe the way Elon Musk will answer that question today. Um, to kind of take the other side of this argument, both companies are burning a lot of cash because they're investing in kind of, in some cases, unproven technology. It doesn't seem like a merger would help with that. In fact, it might just make everything look worse because you're consolidating all these, hugely unprofitable businesses together. What does that mean for the merger? And is that something that people are worried about?
Yeah, absolutely. And you're totally right to point it out. Pretty much all of the big ambitious bets that SpaceX and Tesla are making are unproven, to your point. And I'll say two things to this. Firstly, SpaceX, and Tesla are burning cash. That is true. But Tesla at least has a track record of generating healthy free cash flow through their electric vehicle sales. We'll have to see where they go with Optimus, and they are choosing to invest in this cycle to sort of lay down the foundation for the long-term, humanoid robotics play and for their AI infrastructure. But it, at least to me, was sort of encouraging to see that there is a path to generating cash flow, and at least on a unit level, when they sell cars, those are profitable and generating cash. So I think that gives a little bit of comfort, but your point is still totally correct that these are two cash burning businesses. This is a very, very much like a long term play for investors who believe in the vision and that they will eventually get to profitability. The other point that I think is important to consider here is that the merger would make it easier for SpaceX to actually fund some of these ambitions, SpaceX and Tesla to actually fund some of these ambitions. So in the long term, if they're going to go to the capital markets, they're going to need to raise a lot of equity or a lot of debt, one way or the other, to be able to actually fund their AI build out and to fund robotaxis and to fund, the build out of humanoid robotics. And I talked to one credit executive who was kind of telling me that the idea that they need all this capital, that'll actually become easier for them to go to the debt markets and raise when the two companies are combined. They're both pretty highly rated from a credit perspective. There's a lot of demand for investment grade credit right now. And by bringing them together, by increasing the scale of the company, it might make it easier for them to finance some of their long term ambitions.
Mhm. I mean, it is interesting because I think we are obviously talking about all these different kind of strategic rationales, but as you mentioned in the piece, a lot of this boils down to investors just betting and just following Elon Musk and this idea that, I think as you mentioned earlier, they don't want him to be dividing his attention. And they're such big believers in him that they feel like, you know, if he could focus all of his attention on the combined businesses, that would be better for shareholders. But very exciting and sounds like we'll have a lot to look out for in the and in the earnings call today. Again, thank you so much, Anita, for coming on. And that was Anita Ramaswamy, our financial analysis columnist here at The Information. As AI costs rise, companies are looking for ways to save, and for some, that means developing their own agents. Laura Bratton, author of our Applied AI newsletter, wrote about where this is happening. Laura joins me now to share what she learned. Welcome, Laura.
Hey, Steph. How's it going?
Great. So, you wrote in today's column that Coinbase built its own AI coding agent in April called Forge, and this is an agent that's also able to integrate into Slack. So, this timing means that it came even before Anthropic's Claude Tag agent, which also integrates into Slack. What did you learn through the process of writing this column?
I learned that Coinbase and other companies who have invested in developing their own internal coding agents are now starting to see that investment pay off. That's because just now companies are starting to think about, oh man, maybe we shouldn't be locked into one frontier AI lab, as the government might introduce new policies that restrict how we use these models. As we've seen from our own reporting and with Fable 5. And, as companies might change their cost structures with coding tools, it just makes sense to have your own internal tool or to diversify the set of tools that you have. And so Coinbase is an example of a company that early on invested in creating its own internal coding agent. And, interestingly, it came out before Anthropic's Claude Tag. Both Coinbase and Shopify have coding agents that are available through Slack to all their employees, and you can sort of tag it in channels and work with the coding agent through Slack.
I mean, you do mention in your column that in the case of Coinbase, they still do say that Claude Code is their most used AI coding agent, despite also having this in-house option as well. So, how much is Forge really making a difference there?
I think that it's just an example of companies diversifying their set of tools. So even though Claude Code remains the most popular tool at many companies, they're beginning to explore other options, whether that's their own internal coding agent or others. So Coinbase in particular told me that they see usage of Forge rising as fast, if not faster, than Claude Code. And so I think that that is significant. And they think that it will result in significant cost savings over time, because it lets you sort of connect to any AI model that you want to use through this gateway or router that they have. Whereas with Claude Code, you're primarily using Anthropic's models. And while technically you could set up Claude Code to use with different AI models, and some companies are finding interesting ways to do that, that's certainly not encouraged by Anthropic and not the way they're promoting its usage.
You also mentioned Shopify, which is another company that has its own agent as well that's accessible through Slack. How does that adoption look like compared to what you're seeing with Coinbase? Is it similar growth with both?
Yeah, I would definitely say similar growth with both. In a May presentation, Shopify said that about 75% of the company is using River, which is their coding agent. And they said that, we're all in on River. River's what we use to build Shopify. If anything, I feel like they were even more all in on their internal coding agent than, Coinbase when I talked to Coinbase. Although, interestingly, Shopify still also uses Cloud Code and Codex, whereas I didn't hear Coinbase using Codex.
Mhm. I mean, obviously, kind of the running through line here, which you did touch on, is this idea that companies are coming up with creative ways to save money on AI tools rather than just, you know, defaulting automatically to the big providers. I mean, why is this becoming such a big concern and focus for businesses? And do you think this sort of approach is working?
Yeah, I think that the approach, it's too early to really know how this will play out. In some cases, I could see a future in which companies have developed their own internal coding agents, and then it becomes a form of tech debt where, they're stuck with this tool that it takes time and energy for engineers to keep up with. In other cases, I think that it makes a ton of sense if you have a tech savvy company, and really forward thinking engineers who are willing to spend the time and energy on these things. In Coinbase's case, it took about 7 months, for two engineers to build this tool. So yeah, I think that the strategy we're seeing among more and more companies. And, it makes sense as they look to avoid vendor lock-in and as the pricing shifts more and more to usage among the frontier labs.
Mhm. I mean, 7 months is not nothing. That's a pretty significant amount of time for engineers to be spending their time building such a tool. It's interesting. It does remind me a lot of kind of the early days post ChatGPT, where it felt like this same discussion was happening, but around, oh, should businesses be training their own AI models? Then it kind of felt like over time that discussion settled around, why should I, a business, be spending millions of dollars to train my own model when I can just use, you know, open or closed source ones. Now it seems like it's a similar discussion around, oh, should I be building my own agents to try to lower the amount of dependence I have on AI providers. It does kind of feel like there is just like this middle ground though that a lot of people are doing, which is like maybe I use AI tools from other companies, but I have this model router that you talk about where I can route, and that way I'm not so dependent on any one model provider.
Totally. I think that's a great point. And I think that as we see open source models become more and more popular, I think, as I've mentioned previously on TITV, um, just a couple of months ago, I wasn't hearing from any CIOs that they had any interest in using models other than Anthropic's for coding tasks. And now more and more, we're hearing companies experiment with Chinese open source models to, do coding work. And I think that as at some point we see open source models from the West improve as well, it might make more sense for companies to use open source harnesses like Open Code, which is increasingly popular to do coding work, rather than invest all this time and energy, as you said, in building an internal coding tool that takes time and energy and resources when that's not the primary objective of their business in the first place. Obviously, it makes sense for companies like Coinbase and Shopify that are, tech firms, but maybe not others, more, in other industries outside of Silicon Valley.
Totally. And I mean, I'm sure OpenAI and Anthropic aren't taking this without a fight. What are they doing to kind of counteract this trend and make their models a more cost-effective option?
Yeah, I think OpenAI is a great example. In particular, they've really tried to market Codex. First of all, Codex is an open source harness, and they positioned Codex. Obviously it's optimized for OpenAI's models, but you can use different models with Codex, and they're sort of trying to push this as a more flexible option and more cost effective than Claude Code. And they also will have promotions and discounts. And then Cursor also, I think, is worth noting here because they recently launched a model router and they published a blog showing that, if you use multiple different models, including their own composer model, you can save on costs with coding. So I think that I haven't seen as much of an effort from Anthropic in particular, and as we're seeing, Claude Code at least temporarily has a competitive moat in enterprises. But with the other big firms that lead this space, particularly OpenAI and Cursor, we are seeing some headway made there.
Mhm. Great. Well, thanks so much, Laura. Again, that was Laura Bratton, author of our Applied AI newsletter here at The Information. AI interpretability lab Goodfire announced today it's launching its AI research platform called Silico to the general public. Here to tell us more about it is Goodfire's co-founder and CEO Eric Ho. Welcome, Eric.
Thanks for having me. How's it going?
Of course, excited to have you on. I mean, before we get into your latest product announcement, let's take a step back and just tell me a bit about what Goodfire does.
Sure. Goodfire is an AI interpretability research company, which means that we spend all day thinking about what's going on inside the mind of an AI model. Ultimately, our goal and what we're building towards is a future of intentional design. So, what we mean by that is actually being able to edit and understand and debug models much more like written software rather than training them by trial and error like we do today. So, we want to remove the guesswork from actually shaping and uh, training these models and really be able to deeply understand them and be able to ultimately be able to deeply trust them.
And I know you've talked about in the past this idea of kind of getting a look into the minds of AI models. This is an area otherwise known as mechanistic interpretability, which is quite a mouthful.
It's a mouthful. Say that 3 times fast,
Exactly. So, if we are able to achieve that, what does that mean about the way that we're going to develop and use AI models moving forward?
So I think to start, it starts with understanding. So how do you actually deeply understand exactly why a model is making a prediction? So out of maybe trillions and trillions of parameters and neurons, like how do they all compose? How do they all activate such that we understand every bit of computation that goes into that prediction? And that really, really matters because uh, this kind of sets the foundation for being able to shape them during training, to be able to truly debug their issues. So, right now, let's say that your model likes to talk about goblins or likes to go and hack Hugging Face or something like that. There's really no way to actually be able to pinpoint the specific mechanisms, the computations, why it's actually kind of outputting what it's outputting. The way that the best way, the state of the art of training AI models is just by throwing in a bunch of data and hoping that the models learn what you want them to learn. There's no way to actually go in and specify and kind of disentangle concepts and actually make sure that your model is learning what you actually want it to learn, other than through interpretability. And so it starts by mapping the mind of a model, decomposing a model into its bits of computation, labeling those bits of computation to try to understand exactly how it's coming to a response. And then once you can kind of actually decompose the model into bits of computation, you can then use those bits of computation to monitor the model to make sure it's not doing anything crazy, to explain the model's computation, and then ultimately to train and shape that model uh, such that we get what we want. And so that's what I meant earlier by intentional design. It's building towards a future where we can actually shape these models during training rather than just kind of empirically train them by trial and error.
Mhm. And you mentioned those recent attacks on Hugging Face. Are you saying that if we were able to kind of achieve this ability to read into the minds of models, we could maybe prevent attacks like the ones we saw recently with OpenAI agents hacking into Hugging Face?
100%. Yeah. So I think that's the goal. It's safety, reliability, trust among and get building towards better and safer models overall. So interpretability provides a layer of almost just like ability to shape and control these models that we currently don't have. And it's I think the next generation of machine learning techniques. And that's kind of what we deliver through our product. Silico, you can do long-running interpretability experiments directly on the platform, um, and in a way that you never were able to do before.
Exactly. Talk to me a bit more about Silico, obviously the new product launch that's coming out today. What is it for? What are some examples of how people might use it?
So Silico is for AI research and for AI researchers. So in the same way that like Claude Code and Codex are built for engineers, we really designed Silico with the AI researcher user in mind. So it's for running long-running, asynchronous, parallel AI experiments that report back to you when they're actually done in a really, really visual way. It orchestrates compute. It orchestrates many, many agents behind the scenes that are kind of going out and autonomously executing your AI research experiments. We've
Mhm.
also taught Silico how to do all sorts of interpretability research. So all of the researchers here at Goodfire are the world's interpretability experts in developing novel interpretability techniques. We've kind of taught the agent how to use skills and libraries that we've developed for complex interpretability tasks that were otherwise inaccessible to the general public. So maybe one tangible example is you want to build a cybersecurity guardrail based off of the internal thoughts of the model so that the model doesn't uh, do cyber security problematic cybersecurity things. And so what we can do is you can just ask Silico to on your model train you a cybersecurity guardrail. It will then curated data set, try to extract that set of neurons that are responsible for cybersecurity incidents, and then train you a guardrail that will then be able to be used in production to monitor your model for bad behavior, such as cybersecurity incidents. So this is a cyber guardrail that can be trained on any model, and Silico can end to end execute that autonomously.
Mhm. I mean, to touch on that last point, again, how much is this able to be done on its own? Like you mentioned, you give it the kind of initial task you want it to do. Are you checking, are you as a researcher checking in pretty frequently, giving feedback, or is it something where you give it the task, it runs all by itself, you just show up whatever X amount of hours or days later and it's done?
It just runs. So interpretability is, and a lot of AI research is fundamentally iterative. So it can run for many, many hours. Some of our longer running threads are running for over 24 hours right now, and the agents are still maintaining context, coherence, and getting towards the right answer. But in the example that I used earlier of training a cybersecurity guardrail, uh, you often won't be able to one-shot the exact internal representation of the model that is responsible for the bad behavior that you want. You can mostly extract that, and then often it's an iterative process in order to kind of shape and refine exactly what you want. So you still need guidance, research taste from the actual researcher to shape exactly what you want. And so uh, a lot of what Silico does is it helps you as a researcher give oversight and insight to this set of models to get you what you want, and it kind of elevates the concerns and the potential problems with the agents so
Mhm,
that you can kind of sort them out uh, quickly.
mhm. And, this definitely sounds like it's tying in a lot with this idea called recursive self improvement, which, is this concept of AI models or building AI models that can then help you make even better AI models or do AI research for you. Is that a fair kind of connection? And I'm curious if you have any thoughts on how far along we are in achieving RSI, since that seems to be the kind of latest milestone for AI labs.
Yeah, I think for us, we're trying to elevate the AI research. We're really centering the human in this to make sure that they have the ability to provide oversight to in their AI research and kind of speed up the human as the user. And so, what we're really not trying to do is take the human out of the loop. We're trying to make sure that the human has all of the tools and the understanding in order to make really, really great decisions about their research. And hopefully, we can massively accelerate safety research, security research, and interpretability research, all of which I think are really critical prior to uh, maybe like a runaway recursive self improvement. So I think the last few weeks should have been maybe a larger warning sign and a larger kind of um, a wake up call of models breaking containment. I think these incidents will only get more and more serious and uh, uh, consequential as we get closer and closer to massively intelligent models, closer and closer to artificial superintelligence. And I think the classic kind of stories of recursive self improvement where a model just loops on itself endlessly. I don't think we're really ready for that quite
Mm,
yet, even though we may be approaching that. And so I think that we really need to understand the models and make sure that we can deeply trust and understand the models prior to any runaway recursive self-improvement event.
mhm. Yeah, definitely agree that, as much as the labs talk about RSI, I think once we actually reach it, it'll be a very, perhaps jarring experience, but hopefully, products like Silico can help us
Yeah,
build up
things
the
already
safety
feel
around
like they're
that.
happening pretty fast. So,
Totally.
yeah.
Yeah. Well, great. Again, congrats on the Silico launch today, and thanks so much for joining us. That
Well,
was
thanks
Eric
for having.
Ho, co-founder and CEO at Goodfire. So that does it for today's show. A reminder that we are on the stream Monday through Friday at 10 a.m. Pacific, 1 p.m. Eastern. If you can't make it then, episodes are available on theinformation.com, our YouTube channel, or wherever you get your podcasts. Make sure to follow us on social media on X, Instagram, and TikTok. I'm already excited for our next show, and I hope everybody has a great rest of their Tuesday. I'll be back with you guys tomorrow.